Hello and welcome, everyone. Thank you so much for joining us. Hello, Marilyn.
Hello.
Thank you so much for being here with us. We are excited to get started. This is our Leading in a Crisis virtual summit, and today's topic, C-Suite. Welcome to post-COVID-19, the road to recovery, with Marilyn Landis, President and CEO of Basic Business Concepts, Inc. And I'm super excited about this topic. There's so many questions that are burning in every business owner's heart and soul, keeping us up at night. And Marilyn has been gracious enough to fit us into her calendar. Marilyn, I know you're doing back-to-back conversations like this. Is that right?
Correct. Absolutely.
So I'm just going to say thank you to our sponsors real quick, and then we are going to get to the meat of this program. I want to say thank you to the Whitmarsh Consulting Group, a group of super talented multi-channel marketing experts that are just exceptional at taking a company's marketing mix and repurposing it for today's situation. So reach out to David and his team if they would be supportive. The other sponsor I want to mention is Insperity, HR that makes a difference. I reached out to Insperity before we actually knew what we were going to put together or what speakers we might have on the roster. And I said, would you be willing to sponsor us? They said, yes, sign us up. We're here to serve. Then I went back and I said, well, would you be willing to give something away for free to our audience members? And they thought about it and they said, well, how about a free HR financial analysis report and debrief? And I asked a few questions and found out that that's actually kind of a big deal. They will spend anywhere from 3 to 10 hours with you and with your HR budget and prepare a report. They'll support you in gaining insight into the real cost burden of being an employer, as well as compare your current strategy to what you thought you were going to do in 2020 and 2021, and perhaps what you need to do now, given so many things. What we thought this year was going to be about are no longer accurate. So we know your HR budget is one of those. So if that would be of service to you, reach out to them at turnkeycoachingsolutions.net/HR report. And one more sponsor that I'm super proud of, our team of internal strategists have put together a data-driven crisis strategy approach. It is our strategic planning process that looks at 27 challenges and then supports you and your team in assessing where are you, where you need to go, what's the action plan to get there, and how do you get aligned so that your team can drive for results and then cascade that through your organization. Reach out if that is something that would be of interest to you. My name is Anissa Avon, and I am the CEO of Turnkey Coaching and Development Solutions. We are an enterprise learning and development organization. We have coaches and trainers and OD consultants in every major metropolitan area in the US and in key hubs globally. But what I'm most excited about is this summit that we've put together. And we will be hosting relevant topics every Wednesday and Thursday in April and May 2020, all specifically related to navigating this time of crisis and change, which brings me to Marilyn Landis. I actually stumbled on Marilyn's, one of her talks for, was it the Small Business Development Center that you've done some work with?
I've done work with them. Also, I've done work with the U.S. Chamber.
The U.S. Chamber might have been the one. But Marilyn does for businesses what a really great CFO would do. But she does it with a team of CFOs. And so she's the president and CEO of Basic Business Concepts, which is a multifaceted service firm providing the support to keep businesses financially balanced, on track, and growing. She serves as a counsel, advisor, CFO, and her services are just in time and just the right amount of mix to be of service. But today, what you're going to be talking to us about is how do we get through this as business owners and CEOs?
Correct. And let me bring up my presentation.
Perfect. And I'd love for you to share too a little bit about your background. It's really interesting how you've come to do what you're doing now.
Absolutely, be happy to do that. Let me get this on start. Technology is wonderful when it works.
Yes, it is.
And let me share my screen and we will be in good shape. Forgive me, I'm getting used to your controls.
No problem.
I'm looking for where the share screen is.
Should be at the bottom. There should be a green button.
I see it.
Perfect.
Alrighty, now we're in good shape.
There we are.
As Anissa had said, we're basically looking at the road to recovery. How do we get there? And as she had mentioned, we have a team of CFOs. We wrap the virtual team around companies. Small companies, we become their CFO. Larger companies often hire us to be a consultant to their CFO because they like their CFO. They're perfectly great. They're good, but they're getting into some unfamiliar territory and they may need some skills that they didn't have before. We were around to get our clients through the recession and grow them back out of it. So this is not the first recovery we've had to deal with. In addition to the experience as a CFO, I spent 30 years as a commercial lender, which gives me some insights into lending and debt and capital. I've also testified before Congress 4 times as an advocate for small business, so I'm aware of some of the political impact. I also have a national appointment to the National Regulatory Fairness Board under the National Ombudsman. So that also gives me insight into the regulatory issues that you're facing. So I try to combine some of that as we're talking, so we can look a bit about what's going to be important to you. No doubt we will survive. In tough times, companies prove more resilient than others. Can that trait be learned? And first thing I say to anyone I'm working with, when we talk about all that's going on with COVID-19, the very first rule is breathe. Just breathe. Then I ask these questions. And to all the people who are listening to this, I would suggest stop and say, where are we now? My department, the company, our industry. Where are we? Then where do we want to be? Gretzky is very famous for saying you don't skate to where the puck is, you skate to where it's going to be. Mm-hmm. So where is the puck going to be? Where do we want to be there? Next is, what are the obstacles for getting there? And I'm going to present 3 real world scenarios about the obstacles that I think you will find a lot of common ground with. And lastly, how will the company be better? I had a wonderful friend who always talked about the fact you don't just survive, you thrive. So let's figure out how we don't just survive coming through the COVID-19, but how we thrive, how we're better companies when we come out the other end. What resilient companies have learned through past crises is know your business model. But what's different this time is you need to know the one that you're going to need going forward. This is really tough. You're a survivor. You've come this far, and now we're asking you to go back to business 101 and rewrite your business plan. That's hard, but that's what resilient companies do. Know your cash needs. And that's so often where the non-financial people get tripped up. They haven't thought about what the cash needs are to reopen, to regrow, or just grow. Some companies are going to see this as a huge opportunity to grow. And lastly, know where to look for cash and where that funding might be. Now, you know, if you can see the cartoon, now we know where the problem is. It's Larry on the end, right? He's the problem, all right? First, you have to identify the problem. So let's drill down a little bit on those 3 questions we talked about. When I said, where are we now? Keep in mind that success and cash is going to be dramatically impacted by this uneven opening. We're not all coming to the edge of the cliff together and we're going to jump off of it. It's opening, some places are opening, some are not. And think about the cash needs that might go with this. Will you open and your customers still be in lockdown?
Yeah.
They can't get to you. Or will your customers be open and you're in lockdown? Are they going to go find other customers that they can use? Or maybe your vendors are in lockdown and you've got to find a new vendor who won't give you terms, wants cash on delivery. So all of these things will take cash. How many states or counties are your businesses in? And even small businesses can span 3 or 4 states very easily these days, if not more. So each one will have different rules for opening. One company said we have 2,000 different state, local, and county ordinances that we have to follow for this reopening. So it's going to be, that takes cash to figure that out, to do everything that everybody's going to require. And then if you try calling your employees back, many of my clients have done just that. They got their paycheck protection money, they've called their clients or their employees, and the employees have said no. For legitimate reasons, no. So they're now in the process of having to find new employees. That's another piece of cash. So you need to know where you are now and what the cash needs are. Knowing where you want to be, where will your expertise find the biggest market that can pay you? There may be a great market, but they may not be able to pay you or pay you enough. And we're going to talk about that. And then what are the obstacles to getting there? And how will you be better for having gotten through that? Now, each one of these questions you have to answer with the following. How much cash is needed and where will it come from? We've all been in the corporate setting. I used to be in the corporate world for 30 years where I would have a great idea and get shot down because there wasn't money for it. All right, so have some idea, even if you're not the finance guy, know how to address and ask, and we're going to help you with that. Will the cash investment pay off in increased profitable sales? And how long will that take? Don't turn your ears off on me on this one, because this is something you need to argue with to get where you want to go right now, because everybody's worried about the cash. And then the question that needs to be asked when you're around the table, why are we taking the risk? And how will this risk make us better? Why are we going through this? Why do businesses fail? And this is relevant right now. Think about this. No one saw this pandemic lockdown coming. It happened overnight. I was sitting in a hotel room in Cleveland where I'd met with clients, and I got the announcement that that night at 8 o'clock I'd be locked out of my office. I'm sure we all had similar experiences. So now we must be nimble, creative, and proactive if we're going to ensure recovery for our companies, our departments, our jobs, and even our industry sometimes. So we're going to explore what this will mean financially, even for the non-financial people who might be listening to this call. We're going to talk about how to present your case so it'll stand up to financial scrutiny and you don't get shut down because you hadn't thought about that. So first, let's explore this one option. Why do businesses fail? They run out of cash. Mm-hmm. That's a stark reality right now. All right, I'm going to leave the naive idiots for a conversation over drinks sometime. All right, but that group does. This group doesn't.
Knows at some point or another we call ourselves naive idiots. We have a big dream, and we don't always keep control of the cash the way a CFO might help us.
Or we get off on, the difference for a CFO. For those of you who've not dealt with one, between a CFO and a CPA, I've dragged a few CPAs over to the dark side, so I'm allowed to say this. The CPA is traditionally, and by their training, not meant to be a risk taker. They are meant to get your numbers perfectly accurate and acceptable. The CFO is probably the only financial person in your realm who is willing to take a risk. Now, they're going to mitigate it to death, but they're still willing to take the risk. All right, so question to ask your financial team. This is a key question. Even non-financial people should be asking this of their financial people. What is our current burn rate? Mm-hmm. Traditionally, we only think about that with early stage companies who haven't made a profit yet. Right now, this is true for all companies going through this. And what do I mean by a burn rate? Burn rate equals the current cash that's in the bank divided by your average minimum expenses. That equals the weeks of cash left without a new cash injection. Mm-hmm. By the way, guys, that's your deadline for action. Mm-hmm. So when they tell you what your burn rate is and how many weeks you have, you know whether you have time to think this out over 6 weeks or you're going to make some immediate decisions in 24 hours. Mm-hmm. So that's a critical thing to ask. Many companies, maybe ones you work for or work with or own, may have already run out of cash. And they've either applied for or wished they had applied for an EIDL or paycheck protection loan. If you received a paycheck protection loan and some of that money started coming in the last week or two, and I've been on the phone continuously with clients, you may be struggling with how to meet the forgiveness rules. Pretty simple, sounds like 8 weeks of payroll, at least 75% of your money used for that, the rest toward rent, utilities, and interest, no more than 25%, not that easy. And I will be more than happy to answer all the questions I can during the Q&A, Anissa, when we get to that. But it is good for everybody to know, as of this morning, SBA has announced next week the rules for forgiveness will come out. So the first time we're really going to have some hard rules, and that's important. So let's take a look at the first scenario. And by the way, this is the way my son drew this diagram. This is the way he says he thinks. But I think it's epitome of a brainstorming session. All right. Absolutely. So you're not yet open. All right. You've just given, or maybe you've given the okay to plan a reopening. Your team is brainstorming where the puck is going to be, and the ideas are flying all around the table as you're thinking about things. You know you probably will have reduced occupancy rules. So many people in the store, so many people in the restaurant, so many people in your office, or your desks have to be 6 feet apart, and you only have 12 by 12 spaces. So you know you've got some issues there. You know you're gonna have to worry about personal protection equipment. You know you're gonna have to worry about deep cleaning. You know you're going to have enhanced employee protection so that you're not going to be sued over that. You know you have to deal with the new expanded rules for the FLMA benefits. All of that is going to use cash. So even non-cash people have to think about what is involved in those as those decisions come into the brainstorming. Your customers, where the puck is going to be, will be different than they are now, very likely. They may expect you to provide services differently than they do now. So you're trying to anticipate how you're going to do that. So looking at all those things, your team has decided it's going to pivot to where the market is going to be. It is determined that your traditional market will change. Let's pivot to take advantage of that new market. Well, then that raises some questions. Do you need all your former employees back? Fair question. Can you operate with less? For example, I've been working with the retailers, plans on opening the same number of stores again, but realizes they'll need less employees per store because they've beefed up the website that can act as the back office. So that lets them shift. So they may not be, and they may be hiring the same number of employees, but there'll be more of them in the fulfillment office, more of them on the web, that sort of thing, all right? So if you have, and this is critical, when you're brainstorming around what it's going to take to pivot to where you want to be, if you received a paycheck protection loan, you're going to have to consider the forgiveness rules. What we won't know till next week when the rules come out is what happens if you don't meet the forgiveness rules. Technically, it's supposed to roll into a loan, but we don't know if there'll be a penalty because you didn't spend it the way you were supposed to spend it. And if it goes into a loan, can your company afford the loan? Even at 1%, it's going to have a 2-year repayment period. So you have to look at that. So if you have a payroll protection loan, you may have to balance what you want with what the forgiveness may let you do. You may need different talent coming back, but still have the same payroll or less. If you did not get a payroll protection, you may be feeling deprived at the moment, but you may be luckier because you have the flexibility to do what you need to do. So if you're going to hire, what you have to do is you're brainstorming around and say, okay, we're going to pivot. There's going to be some changes in our employees, and it looks like we're going to have to hire. One of my clients called a manager and assistant managers back ahead of reopening, and they all 4 said no. And their reason was we're afraid. And under the new FMLA, that's perfectly, they can do that. So now he's looking at key people he has to hire that he didn't have before. So what's going to be the cost of that employee? Recruitment costs, training costs, any time for the employee to be productive. I have clients in the inbound call center industry, and they know from date of hire through training to the point where that person can be on the phone with their headset, taking calls, making money, is 6 weeks.
Yeah.
So that's a cost they have to factor in, is 6 weeks worth of payroll for that person. Now there's some pluses and minuses. They need a workstation, maybe. Maybe if we can work them remotely, maybe not. So that's the savings. Hey, finance guys, I've saved you some money. I've got some cost to hire, but I've saved you some money. Then you have to figure out, and you can get your finance people involved, how long it's going to take. If it's going to be 6 weeks before that person's got the headset on and answering calls and I can bill them, well, then I wait to the end of the month to bill, and then they take 30 days to pay. So it may be 60 days before that turns into cash. And how long is it going to take for them to make enough money to make up for 6 weeks of training? Mm-hmm. Word problems, as we talked earlier. Not everybody likes word problems. So even if you don't have this information, if you're sitting with your head's ready to explode because this isn't information you normally keep in your head, ask your finance department for the information. Yeah. That brings them onto your team and onto your brainstorming sessions, and they are now going to be in support of your initiative because they can't come back later and knock it out of the park because you didn't consider things. You've asked all the questions, and you've asked them to help you put the numbers together. Yeah. And we do that a lot for our clients, helping them put the numbers behind the brainstorming that everybody else is doing.
Yes.
Next scenario. Has your business model changed? The two classics are low margin, high volume. Let me give you an example. Let's say you have sales, normally you have sales, and then you subtract from that what we refer to as cost of sales. And that's your variable cost, the cost of the materials, the labor, everything that went into supporting that. So you have your sales, you spend everything you had to spend to make that product, deliver that service, execute that contract. At the end of the day, you have $1 left over for every unit of sale. Let's suppose your overhead is $50,000 fixed expense. You have $1 for each sale unit. Therefore, you're going to need 50,000 units of sale to cover your overhead. And that's not a bad model. Grocery stores operate it all the time. They depend on high volume because they're low margin. Now let's look at high margin, low volume. Your sales, so say the sales minus the cost to produce it. But this time, because you're a higher margin, you got $1,000 for every unit of sale. Same $50,000 fixed expense. Therefore, you only need 50 units of sale. High margin, low volume. Example, jewelry store. Do you ever walk by a jewelry store and say, how the hell they make money? You're just standing around? Well, they can afford to because they have the margin.
Yep.
So now where the question comes in, and you see the little thing on the slide, don't get the two of them confused. All right, that's a sure disaster for bankruptcy. Will the new market you've decided to pivot to have lower margins? Or will you be forced to have lower margins because of all the costs for protective gear and employees and training? Will you have enough volume to cover the fixed expense? Fair calculation. There's going to be unplanned changes you have no control over. Example has been in the headlines a lot recently. Restaurants are told, sure, you can reopen, but you only have 50% capacity. Well, picture your favorite casual family dining, and you love going there because you can take the whole family and it doesn't cost much. Their margins are low. Yeah. So they have to have lots of table turns to cover their overhead. Versus that fine dining one you go to for big events because it's expensive, they have more margin and they have can allow less table turns. Yeah. All right. So that's an unplanned kind of change you have to anticipate. I have a great friend who is a futurist. He said, I don't believe in business plans for 5 years. Nobody knows the future for 5 years. I believe in looking ahead and saying what's all the things that can hit us and planning for them. So these are some of the unplanned. Now, plan changes. Example, if your new target market has low margins, are they going to have money to pay you for your service? They may not be able to write a check as easily as the market you're in right now. Example, again, is the grocery stores. Marketing companies have trouble selling marketing to the grocery store. The grocery store makes the vendors pay for it. They pay for shelf space. Right? So you have to know that market you're getting into, what it's going to look like, and how that's going to affect your business model. So it's key to know what your new market space is going to look like. I had a client expanded in a new market, gangbusters. Growth was tremendous, and they were bleeding cash. Why? They were losing 35% on every sale. All right. They thought it was a great market. They didn't understand the market dynamic for what it was being willing to pay. So caution. If you sitting here listening to us now, you're sitting in that group, and you're pitching a pivot to a market, if that market can't support the overhead of the company, your worst nightmare will have the company agree to that pivot. Yeah. And this is why. This is important. Cash follows profit eventually. The inverse is also true. Process that a minute. All right? If there's losses, there will be no cash. Yeah. So if you successfully grow a market that is unprofitable, you will grow yourself out of cash to pay your salary, among other things. All right, so that's the second real life scenario and the questions you need to ask. The third one, finance types will say, we can't invest in anything. Don't even talk to us about pivoting. We're losing money. All right, don't even talk to me about it. Yeah. All right, first, that's no surprise. The whole economy is in tough shape right now. So it's like, tell me something that's news. How do you read a post-COVID-19 financial statement and get your team engaged? Well, remember one of the discussion we just had about sales less cost of goods, cost of sales? Sales minus cost of sales equals gross profit. That's critical. Gross profit is sales less the direct cost of labor and materials to generate those sales. Focus on the gross profit, not the bottom line. Focus on the gross profit. Ask your financial types to give you gross profit by division, by location, by store, by product line, by contract, however you segregate your revenue. Ask your financial people to give you gross profit by revenue stream. If the gross profit is negative, no increase in volume will save the day. The more you sell, the more you will lose. If you're going to match the hot dogs to the buns, if the gross profit is positive, that's when you will focus on. Then how much more volume is needed to cover fixed expense? That's a math exercise.
Mm-hmm.
All right. If you have brainstormed a pivot and you know it's going to prevent Armageddon, everything is great, be sure it's based on products and services that have a positive gross profit. Otherwise, no amount of government grants will align the hot dogs with the buns.
Let me ask a question now, or you can tell me
Sure.
I can ask it at the end. You know, that piece right there sounds so obvious, right? Let's focus on the gross profit. And if there's not a profit, that's not one we should work to expand, right? And yet I see so many small entrepreneurs as well as large organizations continue to double down on products that are not profitable because it's just what they've done for so long. It's just part of their mix. It would require a lot of effort to pivot away from that. And yet this is not the time in our business life to be shy about, about choosing our time. What is your advice when there's a barrier to that loss, including, you get the idea.
Yeah, and first of all is figuring out what the barrier is. First of all, if the founder of your company, and this is his pet project, you may never win that one. Mm-hmm. Second, maybe, and I have clients in an industry that's had a major shift in technology that has squeezed their margins. So they were not profitable because they had too much overhead. But the new reality is there's nothing they were going to change except their overhead, which meant ultimately letting go of one of the family members. Yeah. All right. That was a hard look at, this is the reality, this is our industry, this is where we are, this is all the overhead we can afford. The other thing is there's a good argument for the fact, well, if we get our volume up and we can buy the product at a better price and volume, then we can afford to do that. So, but those are more complex word problems and they're not unsolvable and they're worth exploring. But in this environment right now, you're probably not going to get somebody to risk their reputation on a change that has got more variables than they think. That there's enough variables out there without adding more. But those are options. You're absolutely right, Annie. So we could say make changes. But the bigger problem I see is most companies don't correctly segregate their cost of goods sold.
That was my next question. Yep.
And there are a lot of industries that the CPA world will often say, and I've got some very sophisticated companies in my base, that their accountants have said to them, do your books on a cash basis, taxes are easier. I have one client that does about $1.5 million in sales, but they bill by fractional seconds of minutes. So it's a very complex business. It should not run on a cash basis. Also, we need to know segregated what the costs are that directly go with everything that they are billing. I work with a restaurant. We move some key things out of overhead and into cost of sales. For example, I don't know if you've ever been to a restaurant and made it on the table. What's that one called? Your reservation on something table.
Oh, open table, I think.
Open table, that's it, right? Well, do you know they charge a restaurant like 7% for that?
Ooh, some restaurants barely have a 7% margin.
Yes, so by moving that up into cost of sales, they knew better how much they had left to cover overhead, because that's a variable cost. The more people that used open table, the more it cost them. And then when they realized how much it was costing them, now that they could go back to open table and try to negotiate a better rate. But you don't know what you need until you can see it. Yeah. So good question. Absolutely things that come up. And of course, never confuse telling people what they think with telling them what they want to hear. I'm often in the position of, as people say, well, you don't want to talk to this guy because he's going to be all upset. And I said, I face Congress. It's okay. I can deal with this.
that is something.
I'm going to ask this group to bear with me because there's a couple more techie financial things that I think you need to have the vocabulary, whether you're a finance person or not, to know about. One, you'll hear this often in a company that You're not getting paid on your receivables.
Mhm.
What are we going to do about that? And of course, right now, that's a real crisis. You're going to look at your list of customers. Some of them, are in the same boat you're in. Some of them you're afraid may go under. You don't know the situation. So first you have to take a hard look at them. Those that you feel will come out of this, that will be solid, that you've got a relationship with and they're important customers to you, you may want to offer them terms.
Mhm.
We'll continue to provide you product or service, and we want you to pay the current invoice and 5% or 2% of the previous one until it's paid off. Some of them you may want to offer discounts because you really realize they're not going to make it all that well. And they may not be in your future. You've pivoted. They may not be in your future, and you just want the cash now. So you may say to them, if you pay me your full balance today, I'll give you a 10% or 15% discount. The other thing is, if you look at your base and say, we've got a solid customer base. We have a solid track record of them paying us. We know they're just going to take a little longer than normal. And we need the cash now to execute this plan that our brainstorming session just came up with. There are very reputable, very good places where you can sell your receivable.
Yeah.
They'll give you the cash today. They'll collect it, and they'll collect a fee for doing that. Often, you'll be told by the general knowledge, but they charge 1 or 2%, and that's too expensive. Well, you're only going to have it out 30 or 45 days. So at most, you paid 1.5%, not 1 times 12. So look into these. They're good. Taking clients through them when we were coming out of the recession. You have inventory that's sitting there unsold, but it's good inventory. It's not produce. It's not going to go bad. There are inventory lenders who will look at your whole cycle. They're not cheap. You get into them and out of them quickly, but it can be spot cash to get you through this right now. Because managing cash right now, it's not a fun job. When there's too little of it, it is no fun. So know where it's being held. Is it in inventory? Is it in accounts receivable? Is it in partially finished work? You may have stuff sitting on a shop floor that's not done. You may have a contract that's partially done. And you may need to accelerate payments going to your customer saying, because you're in a position not to receive delivery, we at least need you to pay us the $5,000, $10,000, or $100,000 of expense we've put into it to this point.
That's right.
And then we'll carry it forward. And in many cases, I'm having clients telling me, people are actually coming to them and saying, hey, I know I'm 2 months behind. I want to get you caught up because I know you're a small business and I want to help you. Wow. There's
That's
a
great.
lot of that going on. So, and the other thing is, if you're going forward, know how long it's going to be before those new sales turn into cash. Maybe your invoices have always said net 10, but in today's environment, your customer's not going to have that money in net 10. I just saw a graph earlier this morning of the status of rent payments in this country. 95% have not paid their full rent amount. Yeah.
Wow.
And 40% have only paid half.
Wow.
So there's a lot of juggling of cash going on. So be realistic. This is a great account. We're going to get it. But it's probably going to take them 45 or have conversations with your lenders to know what that cash is going to take. This is a conversation marketing never likes to have. Sorry.
Right.
Back me all the way up. There's missed the best slide. Here we go. Okay, last piece, bear with me on the finances of this. This is the biggest mistake companies make in recovery. The biggest mistake. All right? They don't calculate what is known as cash in the trading cycle. We just talked about it sitting in inventory, it's sitting in receivables. That eats cash. Think of it as a pipe. And the pipe is as big around as the number of days it takes. So if receivables take 30 days and it sits in inventory on average 45, that's 75 days. Your vendors only give you 10 days credit. So, okay, you're at 35 days. You got to cover that cash. Well, right now, because your customers may be paying you slower, that pipe is going to get bigger. Mm-hmm. And as you regrow, the pipe is going to get longer. And that pipe is full of, think of a pipe full of water. That water's cash. Mm-hmm. I just was doing the exercise for a client, and she said, well, we should have had $43,000 more in the bank. And I said, yeah, it's sitting in your client's pocket because the length of time it's taking them to pay you.
Wow. So
as you go into these markets, you have to figure out, yes, you're profitable. Yes, the cash should be there, but what's holding it? So this calculator, and this is on my website. Anyone that participates in this, or they want to jump on the website, they can put their own numbers in and it'll calculate it for them. And what this does is says, this is the sales we're anticipating post-COVID the next year. Say we think we're going to do $1 million. And this is a math exercise. My calculator would do it for you. you anticipate how often you're going to get paid. If that $1 million will get paid in 30 days or 60 days or whatever, it'll anticipate what the accounts receivable should be. If you have inventory, you put that in there, accounts payable, and your net profit. This is critical. So what this math is saying is for every dollar in sales, you need 66 cents to cover the time you're waiting to get paid. If you had inventory, that might add a few more cents. Your vendors give you 1 penny of credit against that. You got a nice profit, 14%, that gives you 14 cents. So for every dollar of sales, you need to have 50 cents to support it. Now people say, but I'm making profit.
Yep.
We already figured that in at the 14%. It's already figured in. So if sales were in this case to increase 10%, 100,000 increase in sales, you'd have to find $50,400 from outside your company invested in to support that growth. The hardest part is when you came to a standstill and burned through your cash, collected all the receivables you could collect, and now you're restarting. It's like being asked to jump the high hurdle from a standing position. So where's that cash going to come from? How are you going to fund that? So calculate how much working capital you need to regrow and continue to grow, because you're going to have plenty of places pulling on your cash. And if your profit margin goes down, let's suppose the overhead on this company increased. So their profit went from 14% to 4%. We redid this calculation, you'd need $10,000 more in cash. Instead of 50, you'd need 60.
Mm-hmm.
So these are things you look at, less profit, less cash for growth. So remember and again, you can go to the website and calculate it. The biggest mistake I see companies do. Remember, this is an entrepreneurial world. The pessimist sees a barren desert. The optimist sees a really, really, really low tide.
That's right.
All right? I always say entrepreneurs really are not risk takers. We started our business, that's all the risk we could handle. But we are eternal optimists because some days that's all we've got going for us.
Yes.
All right?
Yes.
So work with your financial team, invite them in on the brainstormings. You want to know where the break-even point is. You remember there's a floor to labor and costs. There's probably expenses you can't go below, even in lockdown, that you have to maintain. Some expenses can't be cut. You can cut fat, but if you cut muscle and bone, it's much harder to regrow. Paycheck protection is not for everyone, and I'll answer any questions on those scenarios that anybody might have or on the EIDL program. But there are other programs out there too for companies whose primary expense is not payroll. There's employee tax credits, there's full expensing of capital. There's a lot of other things we can talk about that companies can look at doing. But in this recovery, you have to employ, I call the whole C-suite. Mm-hmm. Everybody at that level needs to be around the table working together until the tide comes in. Mm-hmm. All right. Marketing to do the marketing, knowing the cost of employees and return on that investment, profit to fund growth, a plan to regrow that covers all the aspects, all of those, and that makes the company thrive as it comes out of recovery. Yep. And with that, I end my formal remarks, and I'm open to any questions.
Yay! Wow, so much to think about, Marilyn. And folks that are on the call, please chime in with your questions. I do have some questions about what are you seeing really savvy clients of yours and customers do when, say, they don't have access to capital, but they do have an opportunity to pivot. Mm-hmm. Are they partnering? Are they joint venturing? Are they, leveraging their house? What are they doing?
Well, probably one of the harder things this time, and it was the same coming out of the recession, traditional lending sources are hard to find, and it's likely to get harder. Another graph I looked at this morning was showing that the banking industry in the US, their lending criteria is tightening, yeah. And the curve just went like this.
I saw that.
So that's a critical piece that we have to think about. That's why I stress profits. That's the cheapest form of cash you can get. You may partner with somebody who has more profits right now, and they're willing to aid you together. I read a great thing, was a company that has always been in insecticide prevention, spraying, teamed up with a cleaning company for deep cleaning. They already know how to handle the chemicals. They know how to do the spray. The cleaning company knows has customers who need it cleaned. I have clients who are pivoting and trying to find ways to do it with the least. Some of them are doing it with paycheck protection money. because when their employees have said they're not coming back, they're hiring employees who have expertise in the direction they want to go. And there's some really cool things going on that way when they
That's a
couldn't.
really clever pivot itself,
Mhm.
when your
It
employees
would,
are not coming back.
I have one where the need has always been to really get up to speed with all the latest food and drug, alcohol, agriculture, so they could market to large stores. So right now they got some very high quality talent at a very low price tag because that person's out of work. Hired them, and if this evolves and they get into those big stores, they'll need to continue them in their employ, and they'll have a job. If they can't get into the big stores, it's perfectly legitimate to lay them off. It was something they tried. I have another client who got approval to do telemed for the first time.
Wow.
That client has always had a lot of demand for their services in rural areas. Well, telemed's beautiful for that.
Yeah.
So they're using Paycheck Protection to engage and looking to hire people who have telemed experience where their team does not. And then they can leverage on that. And then when they come out of this, be ready to market into areas, because right now it's not profitable or efficient for them to have somebody drive 2 hours to see one patient. So
Wow.
this will open whole markets for them.
Yeah.
It's a way of looking for ways to make what we have work or reposition the resources we already have. And others are looking for, what can I leverage? One saying, I know my inventory is going to sell slower. Let's go talk to an inventory lender, because that will give me some cash to do some pivoting that I need to do. Let's talk to those who have synergies with us and we can work together. They have something, and I think we're going to see more and more. The small businesses are great at this. I can do this for you if you do this for me, and together we can come out of it. You've got an unused resource. I have a need. I have a client, I've traded off some things. He's trying to get certified on certain things. Can't afford to pay me at the moment. I rarely do this, but it is a friend.
Right.
But in return, he's going to introduce me to a market when we come out of here that I've been trying to get into.
Yes. Yeah.
So
So that's
those are
happening. Yeah.
Yes, it is. It's real. It's happening in a very solid way, because many times we could turn to the rich uncle who had investments. Well, by the way, his portfolio just took a hit.
Yes.
So a lot of the traditional avenues aren't there, and getting back to the basics of organic growth. The other piece is, in the past, no matter how bad things were in the recession, we could still find a lender who would lend against real estate. Right now, that's not so certain.
Yeah.
Everybody's really unsure about that. So I think you're going to see more collaboration, and I'm watching it.
Well, I have witnessed clients and me personally, I've been an entrepreneur all my life. And so when as an entrepreneur, you're backed into a corner, and if you don't have other options, you figure out how to collaborate, how to bundle
Yes.
services, how to collaborate, how to form joint ventures in order to create. And I can just speak for me personally, and for the clients that I've worked with around this. Oftentimes, those joint ventures end up being so much more profitable and rewarding and viable than the original business. We've seen
Absolutely.
that so many times.
Well, you make a very good point, and he said it makes you think outside. That very famous saying is thinking outside the box. And if you've ever done the exercise, it's a set of dots, and you physically have to go outside the box they form to get it all to connect.
Yes.
And this is driving. Entrepreneurs right now, business owners have to be very creative, very nimble. But we are the best business model on the planet because we can be nimble. We're not trying to change the direction of a ship the size of Amazon.
Yeah.
Amazon lost its ability to be nimble years ago. It relies often on smaller companies to be nimble for them. And there's a lot of opportunity there. I have a friend who's written a wonderful book about why the bigs need the smalls. And the reason they need the smalls is we're resilient, we're nimble, we're thinking. And when they've got a problem on Sunday night and dial our number, they're probably going to get the president of the company.
That's right.
And we've got solutions for them. So we may find that some of the bigger companies may be our source, not that they're going to loan us money, but that they are going to give us terms or credit. The other piece is the alternative lenders. There's a group that was doing community could come together, throw some money in a pot to help, and a loan fund would be created on the web that could then lend to that company. Doing great things with it. Well, right now, the bigger need sometimes is a whole community is trying to get a district, a shopping district, or something else whole. So they're offering community loan funds that people can contribute into. really cool things. They also won, and the big advantage with SBA's program is many alternative lenders were licensed for the first time to lend money that was the SBA's or Treasury. And if anyone's interested in alternative groups, go to the treasury.gov website and you can get the list of fintech that's been approved, and there's some really neat names on there.
So clever.
And so these are all great solutions that are now getting main recognition and credibility through this, and lenders you would never think of that have stepped up. The only thing I caution anyone when they're getting out into that alternative space is it's the Wild West.
Mm-hmm.
So you have to ask for references. You want to check with people. There's a lot, unfortunately, of fraud going on.
Mm-hmm.
I get things at least once every 2 or 3 days across my email that says, oh yeah, this is about your paycheck loan, and it's sba.gov/ something else. It's really not .gov. So you have to be careful, and there are a lot of alternative lenders, like any other tech companies, have funky names. So you don't know, they don't make it, not doesn't say the First National Bank, so you don't say, well, of course it's a bank. But there's some great options, and I think we're going to see more and more of that, because what these guys do is come around an industry they understand. And as a result, they can absorb more risk because they understand the industry. Mm-hmm. Therefore, they'll give you that chance that nobody else would, because they understand what you're telling them.
Yep.
And I think that's what's going to get us through this.
Yeah, I was looking at some trends and where we might be headed, and absolutely what you're saying is, we're on the cusp of something very different, to where our traditional lenders are going to eventually have to compete with our smaller alternative, untraditional. And so I think it'll be very good for businesses. I have a question about shifting your sales force, your business development force, to pay for performance. Are you seeing clients figuring out how to do that?
I've watched people try to do that for decades.
Right?
I've watched it. And the hard part is true. When I say people who consider themselves a professional salesperson, they love those jobs.
Yeah.
The problem is most companies are unprepared for their salespeople to make more than the president.
It is so true.
And I tell them, when they tell me they want to do that, I say, well, first you understand, a professional salesperson is saying, I'm willing to take the risk. When I sell, I get paid big. And I know that when I get paid big, I have to save some of that, because when I don't sell, I don't get paid.
Yep.
But most companies, when they get them launched and they really start to make money, then they go, oh my God, they're going to let them go, and they're not making enough. I worked for a bank at one point in my career that will remain nameless, but they hit the front of the Wall Street Journal because they had this huge pay for performance for their salespeople, and they launched it, and it was so successful, they canceled it and never paid a penny in bonus.
So out of integrity. Oh,
yeah. Like I say, it hit the front of the Wall Street Journal. All right, but it's classic because if you're unprepared for what that will be. And then right now, it might be more difficult to find people who can afford to take that risk with you, because they have debts. Many of them, I just read the unemployment statistics, and these people, yes, would love a job, but they're still struggling to pay their most basic needs. And it'll take a while, I think, before we'll get somebody comfortable enough again to say, I'll take that chance. I'm the consummate professional. But what I watched very successfully is a mix of the two. That says we've got a base, and I worked for commission for years, and I used to tell people, if they pay us too big a base, the first time the company's in trouble, we're on the street. If they pay us too much commission, I will be on the street.
yeah. Yes.
So we have to have a mix in between, and I have watched companies very successful saying, here's the base, it's not huge, it's enough to live on. I will provide the resources you need, so I'm not going to ask you to pay for the memberships and stuff you need. But if we hit our targets, I'll share the rewards with you. And I've seen those work very successfully, as long as they put the performance measures in place that are measurable. I quit one company when the incentive they sent me for my bonus, I'm not exaggerating, was 12 pages long. It took an Excel spreadsheet to figure out. When I was being recruited by a competitor, and he said, what's your commission going to be? And I went, I haven't a clue. haven't a clue. So don't overcomplicate it, but make sure it's something and also incent them and things over which the salesperson has control. Otherwise, you disincent them. Many business owners say, well, I want to reward them only if they bring me a net profit. Well, they have no control over overhead.
Mm-mm.
So you disincent them.
Mm-hmm.
You may want to do it on gross profit,
Mm-hmm.
but you have to be willing to disclose to them what that gross profit is so that they know if they're making a difference.
Yeah.
Sometimes you break down the components and say, this is what, but then again, be careful what you incent for. We had one company that wanted to incent their salesperson on how much they were on the road. That was in the days of cold calling, and the more you're out there, the more we're going to get. So she was filling out a report, getting
On the
bonus
road
reports.
a lot.
Yeah, she was charging all the miles from home to the office first before she go to a client, even if the client was a mile from her house.
Mm-hmm. Mm-hmm.
So again, I've seen them work very successfully when they're well thought out and well planned.
Mm-hmm. Mm-hmm. Yeah, that's very helpful. Wow, my mind is reeling. This has been incredibly helpful. Share with us, Marilyn, how does someone, let's talk about how to get a hold of you, why someone would reach out to you, and maybe share with us a little bit about your company and your services and what kind of business owners and businesses work with you.
Sure. Well, one of the things, start with the very basic of what drove me into the business and out of banking. 30 years in banking, I watched some really bright, intelligent, exciting people make careful, well thought out decisions on bad information.
Yeah.
And I realized somebody needed to be on the other side of the table. There was a time when businesses were not as big as General Motors. The assumption was that they were small and local. No longer true. No longer true. They're now complex and can have global reach, even though they might be small. So what we have attempted to do, and then I discovered as the years went by, that the ability to process financial information but not be paralyzed by it, and to think forward and play the what ifs. So thus we created the role that we function as CFOs, which I say are the risk takers in the financial suite, and willing to talk about what ifs and how do we do that and where do we go. And what we find is for many companies, we become their CFO. And we're the go-to person once a quarter, once a month, whatever it is, because they need a dose. As one of my clients said, we ran out of what you told us to do, and now we need to get another dose. All right. We set the plans. We prepare.
Love it.
We have other bigger companies who have perfectly good CFOs. Mm-hmm. In many cases, they're not going anywhere because they're the son of the founder. Mm-hmm. But they're getting into an environment. We're getting a lot of work coming into us now this way because that CFO has never encountered something like this before. We've all seen it. We see the 20-something in front of the microphone with a reporter saying, I've never seen this in my lifetime. Yeah, you're 20. So we get really good people who say, I don't know. Or many companies are pivoting right now to government contracting. And we have a deep expertise in government contracting. So we have had people bring us on board to teach their CFO, help them get into government contracting, and then we can step away. Yeah. We had an 80-year-old company that their market was shrinking. Third generation walked into the boardroom with a plan that was going to grow the company 30%. Scared their existing CFO to death. He had never managed growth. So they brought us in, they were a manufacturer, and we went through 3 or 4 different scenarios and how he could get his arms around that cost of sales number, how he'd get his arms around things, got to the point where he was comfortable, and even the foreman could answer the phone and know whether to pass it up to sales or not. And they're off and running and doing great things. And then we step away. So that's the kind of work the company was created to do. So we've got a team of 16 scattered literally across the country, from Boston to San Francisco and everywhere in between. And what the goal was always to have people I look for on my team and what the best I can find in the country at what they do. So when we sit down with the business owner, we're providing the best expertise I can find to address whatever question it is they have. Brilliant. And most people, I'm on the phone with a relatively new client. We're talking about some of the what ifs going forward, this pivoting you're talking about. They're doing all the scenarios, and my team is helping put the financials around it. Will this work? Will it not work? And what are the risks, and how do we mitigate them? And my personal training is credit risk mitigation. So we go through all that process. At one point he stopped and he says, this is exactly why we have Marilyn's team in here. Because the people around him were giving him great numbers, but no insight into the numbers.
Right.
And often the business owner said, well, I keep asking Mary, or I keep asking John. And I go, you're asking the wrong person.
Yep. So. Well, I want to show folks, can you see, I want to make sure I'm showing my screen, able to see your contact details there. I want to make sure folks have know how to get a hold of you, Marilyn.
Absolutely.
I also, the piece that you just said about it's not enough to have your numbers at your fingertips. I can print a report out of my QuickBooks all day long.
Right.
What is critical at this time is being able to make decisions based on the real numbers, and something you said earlier about categorizing my income. It's one thing to know, oh, my margin overall is 30%, or whatever that fantastic number is. But it's a whole nother thing to be able to look at my customers and say, wait a second, I'm at 4% over here. Right. Why would I bother with a customer that takes me twice as much time? That's where if I could calculate that time, I probably am at less than 4%.
Exactly right.
So there's those numbers help me and other business owners cut the cord in ways that we need to on expenses and clients and customers and ingredients, so to speak, that are the fat. I had one final question for you, and I'm kind of getting to that. You said something really fantastic about the differences. You can cut the fat, but you don't cut the bone and the muscle. If someone were to take one thing away from this conversation about doing their own analysis, about figuring that out, how do you look at your numbers in a nutshell and know where's the fat and where's the muscle?
First rule you have to apply is, does this expense move the company forward? Yeah. There's a fancy accounting term that's referred to as non-operating assets. Let me give you an example. If your office has gorgeous cherry furniture and no customer ever walks in the door, that's a non-operating asset. Mm-hmm. So you look at what you have on your balance sheet, which is a neglected financial tool, and you say, what are the non-operating assets? How much money is going to support non-operating assets? And how much of the money are we spending is not really moving us forward. It's making us cozy. It's making us comfortable. It makes us feel good, but are we really moving the company forward? And the reason I can't call out specific account names is that changes from industry to industry. It also changes in this environment. It used to be location, location, location. So you would not jeopardize your bricks and mortar location. Today, that may not be true. I have a client who for 15 years has had 50 employees, and no one of them has ever worked anywhere except in their home.
Wow.
And so in this environment, she's doing great. Others are trying to replicate her pattern. So her investment was never in bricks and mortar. Her competitors are struggling because that's an industry where the margins are narrowing. And they have to have bricks and mortar and minimum time they give their employees to come into work. So that's shifted. It used to be location was critical in the old days when you had to be close. These days, that's no longer true. So you have to look hard. Every dollar I spend moving the company forward? If not, we either have to put it on the shelf for later or cut it.
Excellent. Fantastic. Marilyn, awesome. I so appreciate you sharing your expertise. Sure. Folks on the call, reach out to Marilyn if she can be supportive. Her team, like she said, is all over the country, and they'll put together a custom package. And I'm excited about our collaboration, Marilyn. And
Excellent.
Thank you so much.
Thank you so much. I enjoyed it very much.
All right.
Thank you.
Stay safe and healthy. Stay safe and healthy, everyone. Thank you.
Bye.
Bye.